IWF's 33% crash versus VTI's 25% drop shows you're paying for higher volatility and longer recovery times when markets tank. IWF took 20 extra days to bounce back from its worst crash, a slower recovery that cost investors precious time. But here's where it gets interesting. IWF's 114% three-year return absolutely crushed VTI. That's the kind of outperformance that separates winners from the pack. Let's zoom in on this. VTI's 78% return sounds solid until you realize it lagged another fund by a massive 36 percentage points. In plain English, IWF finished 36 points ahead over 3 years. But here's the thing. Both race cars followed the exact same highway. The finish line gap doesn't tell you about the journey they took. Here's where the story takes a turn. IWF doubled your money over 5 years with that 101% return, growth stocks rewarding patient investors who stayed the course. Let's break this down further. VTI's 84% return is solid, but diversification means you're giving up some gains that concentrated bets might have captured. Here's the thing though, identical 18% returns over 1 year. But don't be fooled, these two funds take very different paths to get there. In plain English, think of it like a marathon runner. The first mile might look even, but by mile 26, the faster runner pulls way ahead. 1 year hides what 5 years reveals. Let's dig into the details. VTI's recent 3-month gain of 3.6% shows healthier market breadth, more stocks participating in the rally lately. Here's where things get revealing. IWF's negative 3-month return shows growth stocks struggled recently, while the broader market stayed resilient, a notable underperformance worth watching. Now let's put this in perspective. IWF's best year delivered 43% gains, proof that growth stocks can absolutely explode when market conditions line up perfectly. In plain English, like 4th of July fireworks lighting up the sky, IWF exploded 43% in its best year, while VTI reached 33%. Both spectacular, but IWF's burst shone 10 points brighter. Here's the thing though, VTI's best year hit 33%, solid gains without betting everything on a few stocks. Diversification delivered here. Let's take a closer look. In its worst year, IWF dropped 38%. Growth stocks crater hard when investors flee expensive names during downturns. Now here's where it gets tricky. VTI's worst year saw a brutal 37% drop. Diversification helps, but it can't save you when everything crashes together. In plain English, when the storm hit, both funds took nearly identical beatings. IWF dropped 38%, while VTI fell 37%. Different strategies, but when markets crash hard, nowhere's really safe. Let's see how this plays out. IWF's Sharpe ratio of 1.2 means you're getting better returns for every unit of risk compared to VTI's performance. Here's what really matters. VTI's 1.1 Sharpe ratio shows solid risk-adjusted returns over 3 years, though it's trailing behind IWF's performance slightly. Now let's connect the dots. IWF's Sortino ratio of 1.7 means it's delivering strong returns while keeping those painful downside swings under control. Exactly what you want. In plain English, think of it like a report card. IWF earned better grades per hour studied, delivering stronger results for the risk it took over 3 years. Let's unpack this a bit. All right, pause and think. Who's your pick to win this battle, VTI or IWF? Here's the key takeaway. VTI's Sortino ratio hit 1.5 over 3 years, solid downside protection, though it's still chasing IWF's performance here. Now let's flip the script. IWF's 19% volatility means you're signing up for wild daily swings. That's the trade-off for chasing those higher returns. But there's a catch. VTI's 15% volatility means calmer rides. Broader diversification keeps those wild market swings from rattling your portfolio too much. In plain English, IWF's the wilder roller coaster here, swinging 19% up and down, while VTI offers a gentler 15% ride. If you want smoother investing sleep, that 4-point difference matters. Let's dig into the details. IWF's 21% volatility confirms what we've seen. Growth concentration delivers bigger swings, both up and down over 5 years. But here's where it gets interesting. VTI's 17% volatility over 5 years shows total market exposure, gives you steadier, smoother rides over the long haul. Let's zoom in on this. IWF's 33% crash shows how concentrated growth bets amplify pain during downturns. Recovery from these drops takes real patience and conviction. In plain English, think of it like a swimming pool draining. IWF pulled you down 33 feet underwater, while VTI only dropped you 25 feet. That's 8 feet less pain when markets crash. Here's where the story takes a turn. VTI's worst drop was just 25%. Owning 3,500 stocks really does cushion the blow when markets tank. Let's break this down further. 453 days underwater, that's over a year of your money going absolutely nowhere, just clawing back to break even. But wait, there's more to this story. VTI bounced back in 433 days, 20 days quicker than IWF, though both needed over a year to fully recover. Now for the real question, IWF delivered stronger returns at 114% versus VTI's 78%. But you're paying for that extra performance with higher volatility and a deeper 33% crash that took over a year to recover from. In plain English, think of it like a building crumbling and needing reconstruction. IWF took 453 days to rebuild, while VTI finished in 433 days. Both needed over a year to fully restore their value. Here's where things get revealing. IWF's got 63% packed into megacaps. That's why you're seeing those bigger swings and stronger returns we've been tracking. Now let's put this in perspective. VTI keeps just 40% in megacaps, spreading the other 60% across mid, small, and micro-cap stocks for broader diversification. In plain English, IWF's got 63% in megacap eggs, while VTI spreads just 40% there, leaving more room for mid and small caps. It's the classic egg basket dilemma: concentrated bets versus diversified safety. Here's the thing though, IWF's got half its money in tech. So when tech wins big, you win big, but tech crashes, you're hurting. Let's take a closer look. VTI's 33% tech allocation means you're not betting the farm on one sector. Diversification that protects when tech stumbles. In plain English, think of it like ordering pizza. IWF loads up half your plate with tech, while VTI gives you a more balanced meal with just a third in technology and plenty of variety elsewhere. But that's not the whole picture. IWF keeps costs incredibly low at just 0.18%. That's only $180 a year on every $100,000 you invest. Let's see how this plays out. VTI's expense ratio is just 3 basis points. That's $30 a year on a $100,000 portfolio. Here's what really matters. VTI saves you $150 yearly per $100,000 over 30 years. That compounds into tens of thousands you keep instead of losing. In plain English, think of expense ratios like couch change you lose annually. VTI costs just $30 per 10 grand, while IWF takes 180. That gap compounds into real money over decades. But hold on a second. IWF crushed the market with 114% over 3 years versus VTI's 78%. Growth stocks delivered if you could handle the swings. Let's unpack this a bit. VTI's 15% volatility versus IWF's 19% meant smoother rides and fewer panic moments when markets got choppy. In plain English, here's the seesaw trade-off. IWF chases growth with that impressive 114% return, but you're riding bigger swings. VTI offers smoother sailing at 15% volatility, less drama, more stability. Now let's flip the script. VTI's smaller crash matters. Losing 25% versus 33% means you've got 8 percentage points more left to rebuild your retirement with. But there's a catch. VTI bounced back in 433 days versus IWF's 453. That's 3 weeks less stress waiting for your money to recover. Let's get into the weeds here. IWF's higher Sharpe ratio means you're getting better returns per unit of risk. That's exactly what smart investors want to see. In plain English, think of it like mechanical leverage. IWF squeezed out more return per unit of risk. It generated 1.2 units versus VTI's 1.1, making it the more efficient tool for your portfolio. But here's where it gets interesting. VTI's 0.03% fee crushes IWF's 0.18%. Over decades, that difference compounds into thousands you'll actually keep in your pocket. Let's zoom in on this. IWF's 50% tech weighting versus VTI's 33% explains why it soars higher in bull markets, but crashes harder when tech stumbles. Now let's put this in perspective. IWF's 63% mega cap weight versus VTI's 40% shows you're betting big on giants, higher potential returns but riskier concentration. In plain English, IWF's basically betting big on mega cap tech with 63% concentrated there, while VTI plays it safer at just 40%. It's the classic egg basket dilemma, higher potential but riskier if tech stumbles. Here's where things get revealing. VTI crushed it with a 4% gain, while IWF barely stayed flat. Markets are finally rewarding broader diversification over concentrated growth bets. Let's unpack this a bit. Identical one-year returns at 18% can hide very different strategies. Same destination, completely different journeys to get there. Now for the real question. Over 5 years, IWF's growth focus delivered 101% returns compared to VTI's 84%. That's a serious performance gap. In plain English, IWF's 101% 5-year sprint looked great until recently, while VTI's steadier 84% pace proved more reliable. Like marathon runners, the one who paces wins, not the sprinter who stumbles late. Here's where things get revealing. Your choice boils down to this. Chase IWF's higher growth with more volatility, or stick with VTI's steadier, cheaper ride. Now let's put this in perspective. IWF delivered stronger returns at 114%, but VTI's 78% came with lower volatility and significantly cheaper fees overall. So there's your decision. Chase maximum returns with IWF's aggression, or take VTI's balanced approach with better protection and lower costs. In plain English, IWF's for sprinters chasing quick gains despite the strain, while VTI's for marathon runners wanting steady endurance over decades. Choose your race based on how you handle the pain. Let's take a closer look. Before you invest, do your homework and talk to professionals. You're fully responsible here. Now here's where it gets tricky. That's a wrap on our ETF showdown. Hit subscribe for weekly battles where we let the data crown the winner.